Okay, good morning, everybody, and welcome to the Daily Energy Markets podcast. It is Monday, the 9th of October, 2023, and we wake up this morning with oil prices, the market opening in Asia overnight, a big pop up over 5% on Brent, over to about $85. They're not quite 85, but nearly $85, and then pulling back clearly. The news of the weekend has been one that has given the market a bit of a jolt. We had ourselves a survey question on Friday, which asked about, what would be the biggest impact on the direction of travel and oil markets. Geopolitical black swan events didn't get much love on Friday. If we ask that question now, we might get a different result. Omar Najia, Global Head of Derivatives at BB Energy, as always, starting us off the week. Omar, your thoughts, not so much on the politics of all of this, because, of course, everybody's got an opinion on that. But nonetheless, the impact for the markets. We saw after Russia invaded Ukraine last year, the oil prices took on a tear up well above $130, I think we went to. Are we at a similar scale here, or is this just a temporary blip? Your thoughts?
No, I've been bullish the market for a while. I think we saw a healthy pullback, and I'm still bullish the market. Whether you have this war, that war, or whatever it is, then I think the market heads higher. If you want to understand oil, you need to understand geopolitics. If you basically rely on fundamentals and supply demand, that basically tells you very, very little indeed. So it's up to people to kind of decide what they want to invest in, et cetera, et cetera. But we've been bullish for a while, back in June basically, and we're still bullish now. And fundamentals don't really tell you a hell of a lot. And everybody who was saying, markets turned and here we go and prices are lower. There were two very interesting articles from the Wall Street Journal. One said oil prices soared and now they're going to dump because I stopped reading the headline. And the other one was that Saudi Arabia is now going to sign a peace deal with Israel, which made me, not laugh, but kind of giggle. So I think there's a lot of misconception out there in terms of, what's actually quote unquote happening. But geopolitically, I like it to the upside. I like the fact that, demand is here. I like the fact that it's winter. I love the fact that risk, as I keep saying, is to the upside. It is not that everything is okay. And by the way, there's a lot of doom and gloom. Like I think Bloomberg has been saying that we're going to get a recession because their model is saying 100% probability of recession. It's been saying 100% for 8 months. And I think basically you have to try and understand, if your model is saying recession 8 months ago and still saying recession, you might need to tweak your model a little bit rather than just keep saying recession, 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 recession. So
I suppose it's the old adage that a stopped clock is right twice a day or something like that. Jorge Mongeau, welcome back, president and founder of Global Markets. Your thoughts this Monday morning, Jorge? Clearly last week, the beginning of Q4, after the bumper bullish Q3 saw a 30% jump in oil prices. Q4 did start with a bit of a whimper. We lost over $10. Was this going to turn around anyway? What's your read on this very geopolitical Monday morning?
Well, the geopolitical risks are always to the upside, Sean. And the thing comes across in your sessions. The speakers recognize that any political risk is going to create a short-term bullish move. And from a fundamental point of view, inventories are quite low, markets are backwardated, winter is coming, we're not quite prepared, but the bearish picture is very big and is very gloomy. Interest rates are very high. To hold inventories is very expensive. People have to reduce their expenditure. All of these things are terribly, terribly negative. So if you see the market reaction today, there's a possibility and pronouncements and noise and facts that the US is sending more ships into the Middle East, that the Hezbollah may jump in, that the Israelis say, Iran, if you meddle in there, we're going to hit you. So the possibility of a major geopolitical event is so big. The biggest we have seen so far this year and probably in a few years. And yet the market just jumped a little bit. And it has now started to lose ground. To me, it was very interesting to see that the jump didn't even erase the previous downward correction. It just was a mere bump. And you can see markets again trending down. So I think what we have to acknowledge is the fact that if the situation in the Middle East does turn bad, i.e., bombings or destruction in Iran, in addition to what is happening in Israel right now, we will get a serious bump in prices because the world has inventories that are too low, the SPR is depleted, all the things that are clearly evident and we read in the newspapers every day. But if that doesn't happen, we're still facing a sort of weak winter because of the high interest rates. I think the high interest rates are essentially putting a bad cast on everything. And we will see as the day progresses, but what I have seen so far today doesn't impress me in terms of bullishness in the oil market.
Let's welcome Scott Livermore, Chief Economist at Oxford Economics. Scott, I mean, despite all of the sort of downward draft in oil prices we saw recently, we did get a big data point in the US on the end of last week with job creation well over 300,000, much more than was expected. That in itself would put some steam on the sort of at least economic demand for energy. What's your outlook on the sort of macro picture, rates versus growth versus energy demand going into the fourth quarter?
Yeah, well, thanks for having me on. I think until the weekend, all the uncertainty was around demand, and you saw the fallback because uncertainty around China, even positive news for the US has increased uncertainty because what does it mean for Fed? So the US clearly ended Q3 really quite strongly, whether it's the ISMs, whether it's consumer trends, as you mentioned, payroll numbers at the end of last week, really does suggest the US is performing quite strongly and robustly, despite the ramp up of interest rates we've seen over the last 18 months. But that kind of rebalances the discussion at the moment about whether the Fed has reached peak cycle or whether there's going to be more interest rates hikes. And although they left rates unchanged in September, the statement around the meeting was quite hawkish. So the Fed's clearly likely to increase interest rates if the flow of data becomes strongly. And then that creates a greater risk of recession, a less likelihood of that soft landing in the US, which creates more nervousness. So we do think that oil prices are likely to have come back from the slide last week, notwithstanding what's happened to the weekend. And that is going to be a reason why OPEC Plus and Saudi Arabia and Russia maintain their production cuts into 2024 until that uncertainty around demand starts to fade and the outlook becomes more certain.
Omar, last week, of course, when that pullback from on the oil price from sort of the last sort of 5-6 trading days into last week, it sort of threw all structure out of the market. Nobody was short, everybody was long. What impact has it had on the technical reallocation of portfolios? Traders would have to have reacted to last week's drop. How do you see it structurally impacting the positioning in the market, which is very heavily long?
Well, no, I dispute that. I think what you're seeing now is short covering. I don't think you're seeing I think basically that the market topped out not at 29th September, 28th September at whatever it was, $95, $94. 97 WTI. The market actually topped out at the 19th of September. So what you're seeing is basically correction and drop. And this drop that we've had, I think, basically looks to me like a reversal. So in other words, we've had basically 3 waves up. We've had a big 3rd wave up. This is a 4th wave. This is a correction. The market's been correcting since the 19th of September. And I think that correction ended on the 6th of October. And I think we're going to see new highs. So I think what you're seeing over the weekend and now is basically people covering their shorts. And again, I want to emphasize, what you see now, you have a war in Ukraine, you have a war in Israel, but you have basically, this war is economic, political, information, all this kind of stuff. So again, I take you back to the Wall Street Journal articles. Oil prices have topped. Saudi Arabia is willing to increase production once they have this deal with Israel, blah, 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 blah. So there is a narrative that's telling you, and that narrative has been in place since the 19th. If you like to associate price and narrative, that narrative now is finished, not because they decided to finish it, but because it got burnt to a crisp in one day. So I think basically what you see now is you're seeing the short covering, market comes off a little bit, and then basically you're going to see new highs into the end of the year. That's what I believe.
Jorge, coming into the 4th quarter, of course, we're already trading into December contracts, delivery into the new year, which is typically a weaker window of the cycle as we go into the new year from a demand point of view. Where do you see that? I mean, this year we've had a 2.4 approximately million barrel a day growth in demand, still kind of coming out of that COVID recovery period, if you like, sort of 102 million barrel a day market. Have we now completed that sort of recovery from COVID, and next year we should expect a more tepid demand growth? What's your outlook sort of beyond the Q4 window as we're now trading into 2024, at least on deliveries into 24?
I think we need to separate the world into 2 parts.
Okay.
The Northern Hemisphere and the Global South. The Global South economy is still doing remarkably well. I was recently in Vietnam, and boy, the country is booming. If you go to Latin America, things are doing extremely well. But the base is lower, so even if they come above normal, which they will, above trend, the growth in those areas is marginal in the big scheme of things. And in the north, the situation is quite bad. China is underperforming, quite clearly. It's undeniable. Their GDP is tepid. The real estate market is a problem. Unemployment in some sectors in China is a problem. Europe is flat on its back. Germany is the leader of the week, so to speak. The US is performing, but it's not enough to counterbalance all of the negativity we see in Europe. Japan, South Korea, not doing well. So if we look at the whole North, is a minus. And we mustn't forget that the dollar is very strong. So on a local currency basis, people are paying a lot for their energy, and that will have an impact. We shouldn't also forget that the production in shale oil in the US is nearly record highs. So supply always reacts to price, and we had, in effect, over $100 several weeks ago. And at the same time, on a local currency basis, we had a major whack at the time that economies are suffering from the high interest rates. But geopolitics could twist the whole thing on its head. So on a fundamental basis, we are weak. And we will remain weak for the next 6 months until governments decide to stop the misallocation of resources, which is immense right now. So the US continues to borrow and borrow trillions of dollars, and that means that money is not being used efficiently by the market. So the biggest weight right now is interest rates by the US. And the biggest upside is a potential conflagration in the Middle East, which of course nobody wants, and nobody wants to take those steps. And on the whole, I think cooler heads will prevail after some time. And therefore, we could have a weakish winter.
Scott, despite the sort of weak, I mean, as Jorge outlines there, the obvious weakness, particularly in the G7 and China, the elasticity of oil demand doesn't seem to be that impacted. Demand remains fairly consistent at, what we're looking at, 2.5 million barrel a day demand growth this year, and daily consumption, sustaining at 102 or thereabouts, 102 million barrels a day. I'm just wanting to get your outlook for does that get worn down? Are we starting to see any signs where demand destruction is potentially a real consideration here from the impact of economic slowdown and slightly higher oil prices?
Well, I think what we've been discussing, whether the world's in recession, slow growth, maintaining, in the uncertainty around the forecast, that's relatively modest. So I think the kind of slowdown we're talking about, a soft landing, whether the US is slightly in recession or just manages to maintain growth in positive territory, whether China rebounds as strongly as we hoped, or it continues to be a little bit lackluster, weighed down by the real estate sector, as Jorge mentioned. They're kind of not big variants in the outlook. So against that backdrop, whether you're slightly optimistic, slightly pessimistic, demand's likely to continue to grow. Clearly, there are things out there which can derail the economy. We've talked a lot about geopolitical risks. I think probably China, Taiwan is the bigger geopolitical risk. The tensions in Israel clearly have added a premium to oil prices, but if it kind of stays contained within those territories, it's going to have very little ramification globally. There's still concerns that if interest rates remain higher for longer, what does that mean for asset quality, whether there's going to be a more severe financial market correction. And in those scenarios, you're likely to see a bigger correction in demand, bigger drop in oil prices that could offset some of the kind of positive dynamics behind oil prices we've seen of late.
Let's go to the survey question that obviously touches on this subject for today, which is the oil surge as much as 5% after the broadest and bloodiest escalation between Israel and Palestinian militants. Will this be a temporary blip in oil markets like we saw after Russia's invasion of Ukraine? 1, temporary, 1 week. 2, sustain only through October. Or 3, geopolitical risk to remain in the markets. We'd kind of lost the idea that Ukraine was any longer a factor in the markets. Geopolitical risk from Ukraine had kind of been discounted. Is this going to see the resurgence of that temporary, sustained through October, or longer term geopolitical risk to remain? Your thoughts on that? Omar, looking ahead, obviously the week that's in it, there's a lot unknowns with the context of the events that have escalated over the weekend. But looking forward to this week through that noise, is there a market direction?
Oh, yes, I think basically higher. So I think basically oil prices are cheap. Why are they cheap? Simply because if you adjust them for inflation, they're incredibly cheap. So oil has gone up less than, I don't know, the price of whatever it is. So I think, and the other idea basically is that I like the fact that everybody is telling you that, interest rates are going to slow down all the rest of it, right? So they've increased interest rates at the same time. The spending of the US government on various wars and on deficits and all this, they have a $1.5 trillion deficit. So someone explained to me how that is deflationary. I don't get it. So I think what is going to surprise the market, apart from the most anticipated recession that's been anticipated now for 8 months. And people keep saying recession, recession, recession. Apart from being the most anticipated recession is the fact that what if all this spending by the US is actually inflationary? What if the higher you raise interest rates, the higher basically the payments of the US government to do with their borrowing becomes, and you get into a vicious cycle of basically prices going up? I don't know. I have a funny feeling that we're not going to see this market come off the boil, whether it be basically stocks, whether it be oil, whether it be commodities. Again, I was reading Bloomberg. They're telling you nat gas prices are 80% lower. Wheat prices are whatever they are lower. This is what that tells me is not, sell because everything is, going to collapse even more. What that tells me is basically maybe, just maybe, this world is much more inflationary than we think, and basically that prices go up. So I'm not a subscriber to doom and gloom right now. I really am not. I think people should trade markets that are in front of them rather than expectations, because as we've seen, those expectations can kind of last. It's not now. And we have a US government election in November. So if I was the US government and I want to re-elect Biden, the last thing I'd want is basically a deflationary. So I keep inflating, hope for a best, and then we see. So I'm bullish markets.
Jorge, I mean, on the sort of resurgence of geopolitical risk and where it brings forward again, the big theme of the last year or more, energy security and the need for that, and every country has its own policy priority around that. We saw over the weekend China surprisingly releasing a 4th batch of crude oil import quotas for nearly 10 million tons. I'm wondering your thoughts on that decision. Clearly, the all reporting indicates China has put at least 700,000-800,000 barrels a day into its storage this year, as a surplus from its imports. Your thoughts on where China's at vis-a-vis continuing to give crude oil import quotas?
Yeah, in the case of China, it's very clear that they have to take a policy, and you can see this repeatedly, including with the most recent quotas, of ensuring that their inventories are high and that they have enough oil in the event of a major geopolitical event, which is very different of the position that the US has taken, which is to deplete their inventories. But
of course, China, the US has 13 million barrels of oil production a day, and God knows how much gas. They do have inbuilt security there.
Yes, they have. But for a sudden loss of production in the Middle East, your 13 million don't help you, right? It's the issue. You're not prepared for an outage, while China is trying to be prepared for an outage. And despite that addition of implicit demand for China, the oil markets are not performing. So I think we need to abstract ourselves from what is happening in the oil market and focus on what is happening to the interest rates and the overall economy. At the moment, many countries are selling US treasuries, and the US itself, to finance its deficit, is selling treasuries. This results in the price of the treasuries coming down and the interest rate rising up, and therefore dampens economic activity globally. What is going to happen in the months to come? If you keep on doing that, as noted earlier by Omar and other speakers, we are going to have a rise in interest rates that creates a vicious cycle where you need to borrow more to pay the interest. So I think it would be logical to expect that by the end of Q1, as the elections are coming in, the US is going to start printing. It's going to start buying its own debt, pretty much what Japan is doing right now. One hand issues the debt and the other hand buys it, pretending that there is demand for the treasuries. If we go into that situation, which I fully expect by the end of Q1, then oil prices and everything else will react because we enter a monetary printing situation where inflation is very strong. It's not that oil is strong, because if you look at the price of oil relative to everything else, it's actually very cheap right now. And even if the flat price were to rise at the end of Q1, it will rise in line with everything else. So it's not that it's better off. And you can see this situation evidence in the Middle East, right? Saudi Arabia is borrowing money. Even though the flat price is higher, it's not that they're that much better off because everything they're buying costs more. So I think the direction of oil prices hinges on monetary policy.
Would you expect on that point?
Or does the Fed try to print? Thank you, Sean.
I was just going to follow up, or we do have the OPEC World Oil Outlook about to be published in the next hour, being unveiled in Riyadh at the climate conference, I think. But it's expected to show a big increase in OPEC's oil demand forecast through 2045. I'm wondering your thoughts on that, just as a kind of a precursor to that announcement, OPEC revising its oil forecast to 2045 quite significantly upwards.
Yeah, that's like asking if the IEA agrees with that. They will issue another forecast saying that it's down, right? We all bat for home. We have a bias that benefits our position. And unfortunately, nothing is really, so to speak, pure in the analysis. There is a cast provided by the organization. You wouldn't expect OPEC to say oil demand is going to disappear, which will not, by the way. It is more likely to continue to grow, but not at the levels we were expecting. Because
but when you have such a divergence between the world's two sort of major oil multilateral agencies whose data many rely on and research, and this divergence now, which has become increasingly quite dramatic, is that a concern? Does it create volatility? What's your thoughts on it, just on a sort of bigger picture point?
Well, analysis by a political organization will be self-serving. So we shouldn't be surprised that we have opposing views on what oil consumption and production will be.
I suppose it's the scale of the divergence now is much greater than I can ever recollect.
Yes, because we are in a heightened geopolitical environment. And as we are in that heightened environment, you have to expect the two sides to push it even further to the sidelines. And what we are seeing today, if again we abstract from the situation that the short-term geopolitical events, is we had a major bump up in consumption following COVID. Very strong. But now we have the downdraft caused by rising interest rates, and that dampens it. So we cannot expect next year another bump up in the same level. In fact, we could have a contraction if China doesn't perform.
Let's give the last word to Scott Livermore with the survey results. Scott, I wanted to get your thoughts, sort of update on where is Europe. We were talking obviously about this new, very big geopolitical crisis in the Middle East this weekend. The European one seems to have dropped away from being of great sort of impact to the markets. Obviously, it's a great impact to the people living in Ukraine, no doubt, and the surrounding countries. But where is Europe at as we go into winter? Clearly, Germany at the front of that in terms of economic weakness.
Sure. I think if you look at Europe compared to the US, the monetary tightening seems to have taken a greater toll. Clearly, Ukraine, Russia's had a more pronounced impact through its impact on gas prices and the drag it's put on the economy. But looking over the summer months, the data's been really quite poor for Europe. We've mentioned Germany, we've mentioned other countries, but the wind's really come out the sails of the European economy. And that's unlikely to be reversed quickly. So we're likely to continue to see weakness into Q4 going into Q1 next year. unlikely to see this kind of surge in energy prices that we witnessed last year with the ramping up of gas prices. But the outlook for Europe is pretty tepid.
Tepid, there's that word. Not one you want to be associated with, no matter what the context. Not a pretty word, but nonetheless, it seems right on the money. Let's wrap it up there. As we said, oil prices, Brent crude oil trading this morning after the sort of big reaction to the news on the weekend when opened overnight in Asia. It has since come off. It was up over 5%. Now Brent crude is trading up a little over 3% at 87.27, with WTI at 85.69, not too far behind. Thank you so much, Omar Najia, as always, Global Head of Derivatives of BB Energy, Scott Livermore, Chief Economist at Oxford Economics, and Jorge Mongeau, President and Founder at Global Markets. Wonderful to have your insights. It's very important Monday morning. And of course, this week, tomorrow, we will be at the Energy Markets Forum in Fujairah. The big mama of the Daily Energy Markets podcast, of course, is the annual gathering in Fujairah, where we'll have about 300 of our closest friends banging around all of these ideas. And I suppose the backdrop of geopolitics will probably dominate the coffee shop talk there. Thank you so much, guys. All the best.
Thank you. Thank you very much.